The Japanese government is at it again. According to recent reports, the finance ministry is intervening in the yen to some 20 some billion dollars, at least from what we can tell. This follows a couple months ago when the Japanese did a record size intervention of more than $60 billion. And that previous intervention bought them at most a couple days, maybe a couple weeks before the yen started falling back down again. So here we are several months later. The yen is weakening even well past where it had been before, and the Japanese government is still throwing money down the toilet. For what reasons? As we keep pointing out, everybody says this is about the Federal Reserve, this is about interest rates, but as interest rate situation in the United States becomes more and more settled, the yen continues to want to go down anyway. This is not about interest rate differentials. As I showed in a recent video, historical evidence shows that there's very little correlation in most times between interest rate differentials and the Japanese yen's exchange value or other exchange values too, because there has been a very close correlation between JPY and CNY, which tells us this isn't about the Fed, this isn't about interest rate differentials, this is about something bigger than all of that. It's not about Japan and its recession necessarily, except for how that recession might reflect upon the risks across the rest of the Asia and the rest of the world too. So let's bring in Steve Van Meter. Let's talk about the Japanese yen, because the Japanese government, they seem to want to just light dollars on fire and just throw them down the toilet, just wasting tens and tens of billions of dollars for basically no effect, no impact. Yes, there's a short run impact in the day or the couple days after the intervention takes place, but then it's almost like it never happened.
Jeff, that's what I love about this is, they come in and they try to rescue things, and it doesn't matter who. I mean, it could be Japan, could be China, could be anywhere. Central bankers come in, we know what to do. We've got this. And the next thing you know, it's like, no, it didn't work. And, it wasn't long ago, Jeff, that Japan wanted inflation, and they were we need to create inflation. So we're going to monkey with the monetary system, and we're going to do some things because we know best. And then next thing you know, their currency's in free fall, which would actually create inflation. But now the problem is, oh no, wait, that's going to create inflation. We don't want that much inflation. So we have to stop the free fall in the yen. And it just goes to show, Jeff, as we talk about on your show all the time, these central bankers have absolutely no clue what they're doing. They don't even understand how their own system works. They're just constantly reacting to things and trying to make people believe that they do know what they're doing.
Steve, it's all for show, right? I mean, the Japanese yen and its intervention, the government intervening in the Japanese yen, is the most clear example of how this is all for just show. It's all smoke and mirrors. Because as I said, they threw $60 billion at the yen not that long ago, and the yen reacted for a couple of days, and then it just went right back on its merry way, lower and lower anyway. And that's the reason why so many central bankers are most often reluctant to actually act, because they know it's all for show. Their point is essentially to try to get you to do their job for them. So if they can talk you into believing that they're this all-powerful institution, and don't you dare fight the Bank of Japan or don't you dare fight the Fed, then you act in the way that they want you to act, and then they never have to show you how powerless they are. Because you're right, Steve. How many times do we hear this? The central bank is going to rescue the system with its big, powerful tool. Oh, no, we had to invent a new tool because it didn't work. And we just went through this last year with the Federal Reserve, and it's on and on and on. Central banks and their policies are all about creating an illusion of control that nobody really stops and looks far behind. They don't stop and think, okay, the yen was falling. The Bank of Japan, it wasn't the Bank of Japan. The Bank of Japan is just the agent of the federal government. The government comes in and throws $60 billion in the space of just a couple days at the Forex market, and it has no lasting impact. 60 billion, no lasting impact. Why is that? It's not just why is the yen falling, why is the government so powerless to do much about it? And again, it goes back to it's all just smoke and mirrors.
Jeff, you're right. It is smoke and mirrors, and they're trying to get people, particularly investors and traders, to react to it. Because what do you hear in China, when the currency's free falling? Oh, they talk about all the short sellers. And then you hear about it in Japan and the yen. Oh, all these evil short sellers are just trying to drive our currency down. And what do the central bankers come out and do? If you don't back off those shorts, boy, we're going to crush you like the little ants that you are, and we're going to squash you. And we're going to come in with this big, powerful monetary hammer, and you're going to just lose all of your money. And that's just the whole game is we're going to threaten you. And maybe if you just please back off your shorts for a bit and let our currency go up. But the reality is, Jeff, it's not about the short sellers. It's about the economy, and they just don't get it at all.
You know what's funny about the short sellers or the damn speculators? They're always cursing the speculators, right? You know what's funny is the speculators realize how powerless these central governments and the central banks are. So the speculator, you can see this in all the charts and all the data. The speculators, when they know that an intervention's happening, they just step out. They just, okay, let the government come in and do its thing. And then they wait a couple days to make sure there's nothing. And then they go right back to doing what they were doing before. So it's almost like it's not the government spending, in the case of Japan, it's not the Japanese spending $60 billion on rescuing the currency. That $60 billion is basically a free blank check to all these speculators that gives them the ability to just wait out the intervention and then go back and doing what they were doing to be again. I mean, this was supposed to be one of the lessons of the Asian not financial crisis in 97 and 98, that governments actually make things worse in a whole lot of ways. But from the perspective of Japan, and this is where Steve, you're exactly right. This is not about really speculators or the currency itself. From the perspective of the Japanese government, the Bank of Japan, the central bankers, and everything else, they're looking at their situation, their local situation in Japan, and thinking, all right, we've been in recession for maybe an entire year, and it's not looking really good. It's not looking like we're going to get out of it. Now, we keep saying that we're going to get out of it, but central bankers always say that because they have to. So it doesn't look like the situation is going to improve. Then we look across the sea, and there's Korea. Korea is not having a good time, and Korea is a big trading partner of Japan. And Korea, like Japan, is also a bellwether for the global economy. And then they both look a little bit south and into the west, and there's China. And China is throwing up all sorts of really concerning signals here, especially in 2024, which was supposed to be China turning around. And then suddenly you start to realize that Japan's yen isn't really about Japan, Korea, or China. But then we look past Asia and look at the way things are going in the United States, and it's like the global situation looks more like where the yen is pointing than not.
Jeff, that's right, because you think about this from a global economy as you're talking about here. And what do we see out of these Asian nations? Exports to the rest of the world. And of course, when you have economic growth, and I think this is something a lot of people don't understand, that's where you get demand for currencies from. And that's what we're seeing here is the currencies across Asia are just telling us that the global economy is continuing to weaken, despite the fact that maybe we get some, few good prints out of the US data here and there. It's still telling us the direction of the global economy is going the wrong way because nobody really wants the currency. It's not about central bankers overprinting money that people like to think, and, oh, well, they printed so much that, they just flooded the economy with money and now they've got to pay the price. It's not about that. It's about demand for a course that happens in global trade. And so all this is telling us is the economy, the soft landing narrative that's been, encouraged by the Fed, or this no landing scenario, is just not going to happen, because if it was, then what we'd see in Asia is entirely different than what's happening right now.
And it's the other side of that, of course, is the dollar providing activities, which if you're a dollar provider and you're thinking about lending dollars to Japan, getting yen, some kind of yen asset as collateral, you think, do I really want to do this? Because Japan's situation is really bad to begin with, and it's only going to get worse as the situation around Asia gets worse. So there's less demand for their currency, there's less willingness to supply dollars on the other side. It's not about interest rates at all. It's about the fundamental prospects of Asia and the rest of the global economy. It's about the financial risk. I mean, let's talk about that for a second here, because we all know there's commercial real estate problems in the United States. There's commercial real estate problems in Europe. There's a bit of a real estate issue in Japan, but there's a massive monster real estate thing in China. So as the economy globally gets weaker, it only makes those real estate situations that much worse. And guess who's exposed to all of this real estate all over the world? Well, it happens to be a lot of the banking system. And a lot of the banking system is where we get these dollar providing activities as well as demand for currencies. So it's not just that there's risks to the global economy that we're seeing in Japan and China and Asia. There's also the financial and monetary components that when you mix all of these together, the falling yen makes a whole lot of sense, as does in a really weird way. The government's intervention in the yen also makes sense because the last thing you want is to paint a big massive target on your back when the yen continues to fall, and as the situation gets worse, everybody's saying, where's the first place you're going to get out of? It's going to be where the target's painted, and that's Japan's yen. But of course, Steve, the stock market in Japan, the Nikkei is at record highs, so all of this makes no difference.
Yes, that's right, Jeff, because we know weakening currency is going to create inflation, and that's going to just boom Japan's economy along with their stock market. But of course, we know that's not the case. People are speculating on one side, of course, the equity market, as much as they're speculating on the short side of the currency. But I think the risk here is, we talk about why do central bankers come in? Is it all just, for show? And a lot of it is, but there is some risk here because, Jeff, if currencies continue to spiral out of control, we've seen this happen, you get currency crises, and these just don't turn out well for economies at all.
No, they become more than just a problem for Tokyo. It becomes a problem across a whole wide range of banking system and everything else. We're in a globalized system. I think that's one of the problems that people have, and this narrative really doesn't help with that, right? Because we have a national authority in Japan trying to tame the national currency through massive interventions when there's nothing national about anything here. It's international. And that's the reason why these interventions never work, is because the Eurodollar system, the monetary system, the global economy, it's about the entire whole and what's happening rather than just that one part of it. But national authorities can never come out and say, oh, this is an international system, we have no control over it, because no politician has the nerve to say that. I mean, Jay Powell's not going to get on TV and say, by the way, this dollar system, it's not really a dollar system. It's a Eurodollar system. It's operated by banks all around the world. And it is far more powerful than every single central bank on the planet and every single government on the planet. Nobody's ever going to say that. So in one sense, they've painted themselves in the corner where they have to play the stupid game of smoke and mirrors. Otherwise, the other alternative is to admit the truth, which there's no political appetite to do so. And so we're stuck with this song and dance time and time again, where governments continue to tell us they're the most powerful thing ever. So don't you fight the Fed or don't fight the Bank of Japan. At the same time, they're over cowering in the corner, afraid of everything that happens across the global economy when it turns the direction that has turned here.
Yes, and Jeff, and here's what's interesting. Because of the smoke and mirrors that they've created, people believe that central bankers have authority over their currency, which is why you hear things, particularly here in the US, when the Fed hikes rates or tightens policy, well, it's bullish for the dollar. And when they ease policy, it's bearish for the dollar. Now, is it actually either of those things? No, but that's how the market perceives it, and that's how the market trades it. So what you're seeing here is essentially these central bankers in Japan having to deal with the own problem that they created. And that's what's brilliant about it, because the market's essentially telling them, we're going to keep shorting the yen until you do what you don't want to do.
I think that's really we get to that particular point where it's not an either or situation here. It's both. I mean, there's really what actually could turn around the Japanese situation. Well, everybody said, well, the Fed starts cutting rates and they'll take a lot of pressure off the yen. Well, I mean, I hate to tell you, the interest rates are down in the United States, short-term interest rates in particular. The 2-year U.S. Treasury is under 450 again. Rates are already moving lower, and the Japanese yen is still moving lower too. This goes far beyond all of those ideas. But really comes down to is, with all of these very complex topics, we're given a set of narratives and a set of assumptions that we're just supposed to blindly believe in, that central banks are in control of the monetary system. And therefore, when they tell you to do something by raising or lowering an interest rate, you just do it. You don't fight the Fed. In fact, that's what the point of Don't Fight the Fed is about, is just don't think about it. Just act in the way we want you to act. And so you get all of these narratives that continue to form and continue to be traded across the marketplace simply because Nobody really stops and thinks and pays attention to what's happening. We're just, everybody says this is why this happened, so it must be true, even though we can see with our own eyes that it's not the case. And so what the most important aspect of this Japanese intervention is that it pulls the veil back. You can see the little guy in the corner behind the curtain who's nothing but a shabby little guy in a really old and dirty suit. There's not some all powerful, floating head with all the fire and smoke behind it. This exposes the truth to really anyone who's willing to see it.
It's a problem with the Asian economy, and then it goes out further to the entire global economy, which starting in Asia right now. And I'm not suggesting the dollar is going to go weaken and follow suit here. What I'm suggesting is the weakness of the Asian economy is spreading over to Europe, and then it's going to hit to the US. And all of this is a warning sign that the abyss these currencies are falling into are going to impact every major economy around the world.
Yeah, the shorthand, if you really want a narrative, the narrative is when the dollar is up against any of these currencies and these currencies are falling, that's a sign of risk aversion. And there is no shortage of reasons to be risk averse given where we are around the entire world right now. As I said, Japan's in recession. That doesn't look like it's going to change. Their big neighbor in China, some of the most recent statistics from China are really alarming, especially from the banking system. The government appears powerless, no surprise, to do much about that. And then we turn to Europe. Europe's been in a recession too. Is Europe getting out of the recession? Well, it did look like it might earlier this year, but that's rolling back over. No surprise there. And then that leaves just the United States. But the most recent data we get from the United States, including the CPI report for June, suggests that there's likely a recession taking place in the US, if not now, a full blown one, then in the very near future. And of course, it's not just the CPI, it's the CPI and how much that has fit with all of everything else that we've been getting all across the economy, from spending to company warnings and everything else. So if you're looking at currencies as a measure of risk aversion, that makes perfect sense rather than all the other crap that we get from the official narratives about how it's about central bank policies or central bank interventions. This makes far more sense because it's the actual truth.
And you know what's interesting, Jeff, is as you kind of said, the strength of the dollar is just a sign that people that are holding currencies for trade and other means, well, they're going to put their money in dollars because it's not fluctuating as much. I mean, why would you want to hold yen or yuan or any Asian currency right now? Because, well, you're going to lose money on it. And so what makes this really interesting to me is you look at the consumer price index here in the US, and everybody kind of believes, even the Fed, that it's going to make a big run higher. But what's happening is because money's flowing into the dollar, it's actually going to have the opposite effect here. It's going to push the US economy into a recession as well. It's going to drop demand for US goods and services. And next thing you know, this whole thing is just going to spiral out of control.
Yeah, there's that self-reinforcing process with flight to safety. That's really, I mean, in very broad generic terms, that's what we're talking about. When you're going for flight to safety, or if you're risk averse, you don't do all the things the economy needs to continue to operate in some kind of sustained and useful fashion. So flight to safety, risk aversion, these are all negative signals from the economy. At the same time, they're also negative pressures on the economy. And then once it goes too far, as you know, Steve, it gets to a certain point where you just get into this doom loop, the self-reinforcing vicious cycle where the more people become risk averse, the more that has a negative impact on the economy, which rewards their risk aversion. And so getting back to the Bank of Japan, you understand what they're trying to do in very symbolic fashion is try to inspire some confidence to break that cycle. When all it really does is it further reinforces that cycle because they prove how powerless they are to stop it.